Welcome to the Northbound Wealth Podcast. All opinions expressed by Brent, his co-host, or his guests are solely his own opinions and do not reflect the opinions of Northbound Wealth Management LLC. This podcast is for informational and educational purposes only and is not intended as personalized recommendations or fiduciary advice. It is not intended to provide and should not be relied upon for any investment, accounting, legal, or tax advice, or as a solicitation to offer or to buy any securities. Clients of Northbound Wealth Management LLC may maintain positions in the securities discussed in this podcast.
Hello, everybody. This is Brent Foster in the Northbound Wealth Podcast. Today is March 10th. Stocks continue their slide through a volatile week. U.S. trade policy drove much of the market's movements, broadening investors' concerns about economic growth and inflation. The S&P 500 index declined 3.10%, closing out last week at 5,770, while the NASDAQ Composite Index dropped 3.45%, closing at 18,196. The Dow Jones Industrial Average slid 2.37%, closing at 42,507. By contrast, the MSCI EAFE Index was a kind of a bright spot out there, which tracks developed overseas stock markets, rallied 2.85%. So internationals catching a bid here as the U.S. goes through some turmoil. So tariffs take effect. Big price swings and tariff uncertainty loomed over the entire week. Stocks opened lower out of the gate after the White House confirmed the planned 25% tariff on Mexican and Canadian goods would actually go forward. Soft manufacturing and construction data also put broad downward pressure on the markets. Meanwhile, European stocks continue to rally on anticipated defense spending. Stocks fell further as tariffs affected Canada, Mexico, and China. Each country announced retaliatory tariffs of their own, further fanning inflationary fears among investors. By Tuesday's close, all three averages were down 3% on the weekend. The S&P had given up its post-election gains. Markets rebounded midweek after the White House announced a one-month reprieve from tariffs for North American automakers complying with the existing U.S.-Mexico-Canada agreements, or USMCA. The recovery rally built momentum as the administration hinted that exemptions for other sectors could follow. However, as trade policy fatigue rose again, the rebound reversed despite the White House pausing on more tariffs on Canadian Mexican imports until April 2nd. Comments from Treasury Secretary defending U.S. tariffs and downbeat economic reports put further pressure on share prices. The NASDAQ entered correction territory, and for the first time in 5 years, the S&P 500 hit its sixth consecutive day of plus or minus 1% price swings. Stocks continued to fall after an underwhelming February jobs report. Later, markets rebounded as Federal Reserve Chair Jerome Powell said the economy continues to be in a good place and that the Fed was holding firm on current interest rates. The S&P, Dow, and NASDAQ all finished Friday in the green despite being down for the week. The February employment report showed non-farm payrolls rose by 151,000, which was smaller than the increase of 160,000 jobs expected in a survey compiled by Bloomberg. The unemployment rate rose to 4.1% in February from 4% in January. No change had been expected. All but one sector of the S&P 500 fell this week. Financials had the largest percentage drop, declining 5.9%, followed by a 5.4% decline in consumer discretionary and a 3.8% loss in energy and a 3.4% decrease in technology. KKR was hit the hardest in the financial sector, falling 15%. The company priced 45 million shares, or $2.25 billion worth of its 6.25% Series D mandatory convertible preferred stock at $50 per share. Among consumer discretionary stocks, shares of Best Buy fell 12% as chief executive Corey Berry warned of price rises due to tariffs imposed by President Donald Trump. Best Buy also issued a full-year earnings outlook that fell short of Wall Street's estimates at the midpoint. The energy sector's drop came as crude oil futures also fell in the week. Diamondback Energy was among the decliners, losing 12% as the company said it priced a debt offering to raise $1.2 billion. In technology, Hewlett Packard Enterprise, or HPE, shares shed 20% as the company issued fiscal second quarter profit guidance that trailed analyst projections, citing industry-wide uncertainty from the U.S. tariff policy. Hewlett Packard also shared plans to achieve roughly $350 million in late-run cost savings by fiscal 2027 through job cuts. So they're going to lay off people. So its plans to reduce its workforce by 5% or about 2,500 employees over the next 12 to 18 months. Healthcare was the lone sector in the positive territory for the week, edging up 0.2%. Moderna was the sector's best performer, with shares jumping 15%, as a German court ruled that Pfizer and its partner BioNTech infringed a COVID-19 vaccine patent owned by Moderna, according to a Reuters report. The court ordered Pfizer and BioNTech to disclose earnings related to the patent's use and pay compensation to Moderna, according to the report. Next week's earnings reports are expected from companies including Oracle, Adobe. Economic data will feature the February Consumer Price Index and the Producer Price Index, two closely watched inflation readings. So year to date, the Dow is up 0.39%, MSCI is up 11.21%, NASDAQ's down 6.33%, and S&P 500's down 2.22% as of close on Friday. The 10-year Treasury note has backed off a lot. It's at 4.32%, and that from a month ago, it was at 4.49%. So we're watching the 10-year note. That should make mortgage rates come down all the more, and they actually have. Thank you, YCharts, for that information. YCharts.com. Under the hood, the Institution for Supply Management published fresh manufacturing data on Monday. Although the headline numbers were decent, a closer look revealed that new orders dropped in January from a years-long high into correction territory, while deliveries and prices paid jumped up. Companies were pulling forward orders due to anticipated tariffs. So that data is not surprising. It's kind of expected. We're going to be tracking the jobs openings report Tuesday, the NFIB Small Business Optimism Index. On Wednesday, Consumer Price Index, the federal budget, Treasury announcement. Thursday, Producer Price Index, or PPI, and initial jobless claims. And then Friday, Consumer Sentiment. And let's see here. Or not a whole lot on earnings front. Okay, so tax tip of the week. Are medical and dental expenses tax deductible? If you file your taxes using itemized deductions, you may be able to deduct medical and dental expenses for yourself, your spouse, and your dependents, according to the IRS. You may deduct only the total medical expenses exceeding 7.5% of your adjusted gross income. Some types of medical care expenses that may be deductible include payments for the diagnosis, cure, treatment, and prevention of a disease, payments to doctors, dentists, surgeons, chiropractors, psychiatrists, psychologists, and non-traditional medical practitioners, paying for inpatient hospital care or nursing home care, fees associated with inpatient treatment for alcohol or drug addiction, payments to participate in weight loss programs for a specific disease diagnosed by a doctor, such as obesity. This information is not a substitute for individualized tax advice. Please discuss your specific tax issues with a qualified tax professional. And this tip was adapted from irs.gov. All right, stay tuned for the next segment. The evolving role of women in family finances. This is an article that I put out on the blog. March is Women's History Month, and according to a recent survey, 49% of women consider themselves to be the chief financial officer of their households, and that's up from 41% in 2021. Those numbers are even more impressive when you consider that until 1974, a married woman often needed her husband's permission to open a bank account, apply for a credit card, or sign up for a mortgage. Times sure have changed. However, in today's economic environment, only 64% of women say they feel financially secure. That's down from 72% in 2021. Despite the challenges, there is no turning back the clock on women's drive towards financial independence and their increasingly important role in their family's fiscal well-being and the global economy. It wasn't always this way. It may be hard to believe that women had so few financial and banking rights just a few decades ago, while today more than half of all women are in the workforce, and women can't be refused credit based on gender. In 1970, only 43% of women were in the labor force, and women could be turned away by lenders if they didn't have a male cosigner. The past 50 years have seen tremendous changes in women's roles in personal finances. Thanks to hard work, new laws, and regulatory changes, new norms emerged. The chart below on the blog highlights some of the milestones that built on each other to reshape gender roles, family dynamics, and society in general. So, in 1970, these Equal Credit Opportunities Act is passed. It's women's focused community banks open. 1980s was the first female trading exchange president. More women earned college degrees, creating broader career options and higher salaries. In the 1990s, FMLA helps women remain in the workforce. Women's participation in the workforce reaches an all-time high in the 90s. The 2000s, a new law adds protection against pay discrimination. Number of female Fortune 500 executives or CEOs rises in the 2010s. The first woman was nominated as the Federal Reserve Chair. Most working mothers are breadwinners in the 2010s. And then in the 2020s, women tend to save more than men, but still they earn less. More men have emergency savings than women. That all is a source of Bankrate, May 28, 2024. So check that graphic out on my blog. So, what's the current landscape like? Well, today, women are financial decision makers, with nearly 50% taking a lead role in the family regarding money, some by choice, some by necessity. Progress has been made towards accessing credit, investing, pursuing higher education, and having career opportunities, with the days of women taking a backseat and financial decisions increasingly a thing of the past. By 2030, women are expected to oversee $34 trillion in the United States. That's about 38% of all investable assets. That's almost double from last year and an increase from the 7.3 trillion women controlled just a decade ago. Women are controlling more assets and increasingly becoming the financial heads of the households due to several factors, including inheritance, divorce, and career success. There are now at least 62 female billionaires and ultra high net worth women, defined as those with $30 million or more, has increased from 6.5% of the ultra high net worth population in 2010 to 11% in 2023. As financial professionals, we're keenly focused on meeting women's unique needs and preferences and are committed to building strong relationships with all of our clients. Women have a different approach to investing and family financial goals. We treat all clients as individuals first and customize our services and support to their unique needs. Our experience has shown that women tend to have different priorities and approaches to investing and setting financial goals for the family than men. Here are some ways the gender can influence investment decisions. So, financial confidence. While many women are confident about their daily financial management skills, some are less confident about investing. For example, one study showed that 75% of women feel confident about balancing a checkbook, but only 19% are confident about selecting investments that align with their goals. Taken further, while 52% of men say they're confident that they are on track with putting money away for retirement, only 42% of women feel that way. It's no surprise then that women tend to be more pessimistic about whether they are accumulating enough assets for retirement. Investment discipline. Women tend to be more conservative than men regarding the investments they choose. Women are also more conservative about the returns they expect from their portfolios. Avoiding the next hot investment may have its rewards. Patience can be a virtue. So, a Wells Fargo survey showed that women trade 27% less frequently than men. Wells Fargo attributes this to the financial confidence issue, where overconfident investors are more likely to trade frequently, believing they know more than the market. Interestingly, when men share accounts with women, they trade less, even though they tend to take the lead in their trading decisions. Managing market volatility. We have seen that women are more likely than men to wait out market volatility, and the Fidelity survey backs that up. While 43% of men said that they will do nothing, and 9% will decrease their investments during market turmoil. 51% of women will wait out the volatility, and only 6% will decrease their investments. Women are also less likely to use a correction as a buying opportunity, with only 16% saying they would increase investments during volatility compared to 28% of men who would put more money to work. Women are more philanthropic. So, according to Bloomberg, regardless of age or income level, women tend to donate more to philanthropic causes than men. With more money at their disposal, women are likely to give charity in increased numbers over the coming decades. Women are comfortable asking for directions. So women tend to be more collaborative than men and more open to guidance when it comes to investing. According to Fidelity, 86% of women agree that having their investments managed by a professional makes life less stressful. At the same time, 77% of women believe that they would be more confident with the help of a financial professional. So finances can cause conflicts. So finances can and often do cause tensions between spouses. Fidelity Investments Couples and Money study states that nearly 1 in 4 couples say money is their greatest relationship challenge, with 45% of partners saying they argue about money at least occasionally. More than 1 in 4 admit to being frustrated by their partner's money habits, but let it go to keep the peace. The Fidelity study details that 53% disagree on how much savings is needed to retire. 47% disagree on how much risk they're comfortable taking on in their investments. So their investment strategy. In our experience, effective communication is key to managing conflict and helping increase a couple's chances for financial success. By communicating, couples can discuss their finances, talk honestly about how family money is handled, and agree on short and long-term goals. As financial professionals, having both partners involved in setting financial goals and driving decisions can help make client meetings more productive. There doesn't always need to be an agreement, but leveraging each partner's strengths and listening to their perspectives can help us build consensus and implement financial strategies. Women face challenges and opportunities. While women's roles in the workforce and society have evolved significantly over the past few decades, many women still face unique challenges in pursuing their financial independence. Barriers include the gender gap pay, financial education, and lingering societal expectations. While women still earn less than men, they also are more likely to work part-time and take time off throughout their careers to care for children or other family members. Financial independence is also potentially even more critical, given that women typically live an average of 5 years longer than men. As part of the coming great wealth transfer, women are expected to inherit as much of the $68 trillion in wealth that baby boomers are passing down. Whether husbands are leaving money to their wives or couples are passing a nest egg down to their children, women may benefit disproportionately, and they need to be prepared to handle this influx of wealth. Women at all income levels can pursue financial empowerment with the right knowledge, tools, and support. Building independent credit. As an important step towards financial empowerment, one critical yet often overlooked aspect of financial independence is establishing and maintaining a personal credit history. While it may seem convenient to be listed as an authorized user on a spouse's credit card, this approach doesn't offer the same financial security as owning individual credit accounts. Without credit in their own name, women may face challenges when applying for loans, securing housing, or even starting a business. Opening and managing personal credit cards responsibly, using credit, and maintaining a healthy credit score are steps that may help with long-term financial independence. This proactive approach might also put women in a stronger financial position in the event of a major life change, such as divorce, widowhood, or spouse's financial mismanagement. Building independent credit strengthens overall financial resilience and supports greater autonomy in making major financial decisions. Empowering women to take control of their credit is a foundational step in pursuing lasting financial security and independence. So, working with a financial professional can help women on their journeys. Despite the change in attitudes around women's decision making regarding finances and investment, some lingering biases can still impact the quality of the services women receive. By being aware of these oftentimes unintentional biases that treat men and women clients differently, you can find a financial professional with whom you can build a strong and trusting long-term relationship with. That would be awesome. We should all embrace the opportunities presented by women's evolving roles in family finances. The contributions women are making are game changing. At the same time, women must also often balance careers, family responsibilities, and financial goals. It's not always easy as gender and family dynamics evolve. Remember, the importance of open communication and collaboration in seeking your family's financial goals is paramount. So, as we wrap this up, we celebrate Women's History Month. It's inspiring to see how financial roles within families continue to evolve no matter who takes the lead in managing finances. Thoughtful preparation and collaboration are key to building long term investment strategies and a financial plan. We're here to support you and your family in navigating every stage of your financial journey, helping you become more confident when making decisions and create lasting legacy for future generations. All right. I actually have two daughters and a wife. And my brother's got four daughters. So we're going to be having to teach and educate the women of the next generation and hopefully their husbands. That will be a lot of fun. All right. Stay tuned for the next segment. Hey, this is Brent Foster. Welcome to the Technical Analysis Spotlight, March 11th, 2025 edition. Okay. We're in the middle of a correction or a pullback. Just on February 19th of 2025, we hit all-time highs in the S&P 500, 6147. And now we're trading around the 5,600, upper 5,500s range. And we're experiencing a, 8% pullback to 8 to 10% pullback at this point. And that's normal. We've had 2 years back to back of 20 to 25% returns in the S&P 500. 2022 was a negative year for the S&P 500, so we had a really tough year with the markets in 2022 and in the bond markets in 2022. Both were negative on the year. It was a brutal year. It was a bear market. Then we came out of that rip roaring in 23 and in 24. And here we are getting our first pullback. I talked about this on the podcast last fall. I said, telling clients, based on the charting analysis and the work that we do here at Northbound, I was like, there's probably going to be a correction in the first quarter of the year. And here we are. No surprise. It's been a pretty orderly market. Still, we are bullish on the stock market. The earnings, the guidance, the economy, is really constructive. It's okay and natural to have pullbacks. They're actually healthy. Up and to the right in a straight line forever is not how the markets work. It's not how risk works. It's not how price discovery works. It's literally not the way of the market. However, if you do some work and you do some reviews of the stock market, you'll come to the conclusion that there's a hit rate over the last 45 years is 75% of the time the markets are going up and to the right. So I'm going to dive into that here on this technical analysis spotlight. And I just want to bring in some historical data. I'm going to actually post this JP Morgan Guide to the Markets slide 16 on the blog on the website. Annual returns and intra-year declines. Okay, annual returns and intra-year declines. So the S&P 500 intra-year declines versus calendar year returns is what this is about. And basically, the header of the slide says, despite average intra-year drops of 14.1%, annual returns were positive in 34 of the last 45 years. So that's a 75% hit rate on investing. So I just look at these pullbacks and soft patches, maybe some uncertainty as an opportunity. If you don't have equities or don't have stocks, as an opportunity to invest and maybe take on some risk for future growth of your portfolio. You want to be greedy when others are fearful and fearful when others are greedy. So it's kind of that's a Warren Buffett-ism, and I figured I would spit that out here. But just so you know, this chart shows intra-year S&P 500 declines as red dots, as well as the full year gray bar. And you'll see that on the bar chart. This chart makes it clear that double-digit intra-year declines are typical, and that more often than not, the market still finishes in a positive territory, encouraging investors to stay the course. And this data comes from FactSet, the Standard & Poor's, JP Morgan Asset Management. And the disclaimer would be that returns are based on price index only and do not include dividends. Intra-year drops refers to the largest market drops from peak to trough during the year for illustrative purposes only. And returns shown are calendar year returns from 1980 to 2024, over which time period the average annual return for the S&P 500 is 10.6%. Okay, let me repeat that. Over that period of time, the average annual return was 10.6%. Guide to the markets, US data are as of February 28, 2025. So it does have a little bit of 2025 data in there. We're having a 5 to 8 to 10% pullback. And it's all based on growth fears. I feel like growth fears. So the future doesn't look as bright given that the Trump administration is going after countries and trying to shake things up a bit with trade and tariffs, and then basically immigration and deportation and laying federal workers off, and maybe it's just quite a bit of shaking the tree going on in the federal government with the new administration, and it's I think. It's just, I think, providing an opportunity to rebalance portfolios and reassess risk and understanding where your portfolio is at and where the future is. I do think that calm hands prevail, steady as she goes, stick to your investment strategy. Don't panic sell. There's a lot of panic selling, it looks like, going on, just indiscriminate selling, people just not knowing what's going on. That's actually proven to be one of the worst things you can do, especially if it's just a near-term correction and the charting looks like that's what the case is. The Qs or the NASDAQ 100 is in a similar situation, a little more pronounced given that it's tech-heavy NASDAQ companies, a little more volatile than the S&P 500. But again, it's potentially an opportunity to get long some real good themes like technology or health sciences and maybe AI and that type of thing. All right. Let's see. Moving on, I'm going to take a look at the S&P 500. I typically talk about some indicators that I look at when I talk about the technical analysis spotlight. And for those of you who kind of geek out over this stuff, great. I'm just going to try to keep it high level. So what I like to look at is a couple of indicators. The New York Stock Exchange, so the $ NYSI, and the McKellen Summation Index, ratio adjusted EOD index. So I like to look at this as there's an oscillator of full stochastics, a couple of them, and then I've got the New York Stock Exchange on there, and as far as price and volume underlying, and then the S&P 500 or $SPX over the top of it. So I'm able to see what the price action's doing and understanding what the internals of the market are doing. And those indicators on the top two for the full stochastics are at 0. And that's indicative of a corrective or a declining pattern. And then when I take a look at the price is following through along with that. And it hasn't hooked up yet. So we're still kind of in this declining pattern, trying to find a bottom. My period of time is daily. My range is 1 year. And so I like to check that indicator. And then another indicator that's similar to it, but on the weekly, okay, instead of a daily chart, I pull up the weekly chart of the same thing and I zoom out a little bit more to 4 years, and what you see is the S&P 500, again, correcting. I waited until today to talk about this particular chart because I want it, updates once a week on Tuesdays. So we're not quite to zero on the weekly chart. So that means there's a little more softness to go or a little more selling to go before we finally reach a potential bottom. Okay, so like I said earlier in this little segment, we were on February 19th at 61.47 for the all-time high, or 61.50 right in there. And now we're trading around, let's see here. What is that? 55.65. I was sharing with a friend of mine, also my brother and a few other clients about where I think the market's going to head. I think it's probably, we're getting close to being completely oversold, to the point where I think buyers are going to step back in. But 5,500, 5,400, 5,500 on the S&P 500 in the near term. And we're just in the middle of this correction. So it's like we're 3 weeks into it, 3 to 4 weeks, and it could last another 3 weeks until the end of March before we kind of have a bottoming process and maybe ripping higher coming out of this corrective pattern. Now, all of this is forecasting and prediction. That I do not have a crystal ball, but I've been doing this long enough to understand how these things work, and we take it day by day, week by week, and stay on it and look at the charting and the patterning. And if we're starting to build a base, hopefully we can identify that as early as possible using all kinds of different studies. Another chart that I like to look at is the VIX. So I was talking to a couple clients in my intern yesterday about, well, let's check the VIX. Let's check out where it's at. And it's trading at 28. Yesterday, it was around 28, 29, almost 30. And if you zoom out on a VIX chart with the 10-day moving average, 20-day moving average, 50-day moving average, 200-day moving average, and Bollinger Bands, you're able to see, along with the ADX, or advanced decline ratio, over 14 days, you're able to see that these VIX spikes, when you get up to a spike of like 30, historically, that's a good potential buying opportunity. It could be a buying opportunity to buy into equities or take cash and deploy it. Because again, you want to be buying at a low, not a high, right? So this isn't advice. It's just me reading charts and talking through some of the thought processes I have. And I just look at the last VIX spike that was up here was, let's see, back in 2024, right around December, we had a spike of the VIX, didn't quite hit 30. It was more like 27, 28. Prior to that, it was the summer of 2024 where we had a spike. The VIX actually hit 65. It was that unwind of the yuan trade. But I would say the closing VIX spike was around 40. So that was a 10% correction, but the year ended up doing really, really well for 2024, right? Up 25% in the S&P 500. So imagine if you had bought that and got it right, got the timing right and bought that, you'd be up even more than 25% last year, most likely, if you bought the S&P, the index itself. Okay. So, again, just in the last year or two, and if I even zoom out further on the years and go out, let's say I change that chart to go out 3 years, you can really see the VIX, and the spikes in the VIX are practically inverse of the equity market. So, and that works in times of a bull market. We're in a super cycle bull market. It's likely to last another 7 to 10 years, maybe longer. And we'll see where this goes. Okay. So, be greedy when others are fearful, buying some of these dips, especially like dollar cost averaging through your 401k and continuing to add when the market is down is a wise move. Don't panic sell. It usually is. It turns out not to be a great move. Not all the time. I did live through 2008 and 9, and that was rough. But because it was such a long, drawn out bear market, and it just was really devastating. So that's not beyond me on that one. So it doesn't always work 100% of the time, but when we're in a good economy and we're cruising along, not a bad idea. Okay, so enough of that. I like to look at the summation indexes. I like to look at Bollinger Bands. I like to look at the VIX. I like to take a look at crossovers of the S&P 500, where the moving averages are at, Fibonacci retracements, and trading around 55.69, the fib retracement. We're getting to about that 50% pullback from that last move. So I think we're close to being done. 5,400 holds. That'd be nice. And then we can start to base up and go higher from there over time. And we'll see how this year turns out. But a lot of the most bullish cases, as far as predictions are concerned, from economists and strategists at the beginning of the year, are now having to rethink that. Doesn't mean it can't happen still, but like we talk about every January, a lot of the strategists are wrong. They're too bearish for a year, like the last couple of years. The market rips and just makes everybody humble, and then when they get too bullish, you can be humbled again. And so it's good to have try to be as non-biased as you can behaviorally, set a strategy, have some rules around that, have it line up with your financial plan, talk to your financial advisor, get with it on it, add money if you can when the market's down, not when it's up all the time. Okay. All right. So thank you for listening to the Technical Analysis Spotlight. I've spent enough time on this, so I'll move on. But check out the blog, check out the website. If you have any questions for us at Northbound Wealth Management, don't hesitate to reach out. 317-399-1107. Have a great week and weekend. Take care. Bye-bye.
Whether you're just getting started as an investor or you're managing a multi-million-dollar portfolio, Northbound Wealth Management has the solution for you. It all starts with building the right financial plan. To speak with a financial planner today, visit northboundwealth.com. Don't forget to check us out on youtube.com at Northbound Wealth. And make sure to leave a rating and review on your favorite podcasting app. Thank you for listening.